the things that are being talked about right now, or that we're about to talk about, some of it, a lot of it is going to seem like, what am I looking at? That's completely okay. It's to be expected. So, just remember that. I definitely suggest that you get pen and paper so that you can take some notes. Definitely a big fan of kinesthetic learning. So yeah, with that being said, we're going to jump into it. I'm Shania, for everyone who doesn't know, but I'm sure you do. Kevin, you want to introduce yourself?
All right, I'm Kevin. I'm Kevin Hobbs. All right, for all y'all who don't know.
All right, let's get into it. Oh my God. Okay, so tools needed to trade successfully. All right, number one, you need a TD Ameritrade account. There are other brokers out there that you can trade with. Okay, the examples that you're going to see tonight, they're going to be pertaining TD Ameritrade. I'm not sure how any other platforms work as it pertains to placing a trade, getting out of a trade, even finding the option chain. But I'm sure they all work in a similar manner. But the thing I like about TD Ameritrade is even if you don't plan to start trading anytime soon, I think it's still important to just go ahead and open up the account, because they allow a free paper trading account, and you can practice and try and follow along with the trades, that are called out, just to make sure that from a basic standpoint, you understand how to successfully get in and out of a trade. Okay, so definitely go ahead and get a TD Ameritrade account open. Like I said, it's free. You don't have to fund it to be able to trade on the demo account. So definitely do that. You're going to need a trading view account. You can create a trading view account for free too. So you're definitely going to need that. We're going to show a little bit more on trading view. I really, really, really recommend a trading journal. All right. So demo is one thing, right? But when you start live trading, it's really important to understand the mindset behind why we're calling the setups that we're calling, and not just the mindset, but the analysis. Okay. Because it's both together. So I found that kind of journaling, and I journal a little bit differently. I just do post-trade analysis in the group. But I find that journaling in some form, whatever floats your boat, is going to be really, really, really key to, maintaining discipline. And again, making sure that you can repeat certain trades by looking for the same high quality setups again and again. All right. So really recommend a trading journal. If you don't have one, just get a standard notebook. One of the my office is a mess, so I can't find it right now, but one of the little black and white notebooks, a spiral notebook, whatever, just get, something that you can kind of write in with the date, and really just kind of rework yourself through the analysis. All right. Or even if you're not doing the analysis, what you understand from our analysis and what you don't understand, and then you can come back with questions. All right, you're definitely going to need some discipline. You're definitely going to need a lot of patience. If you don't have these two things, then you will not be successful, no matter how much money you start, with in your bank account. The richest person in the world can come into trading, and if you don't have discipline and patience, you're going to lose all your money. All right, so that's really important as well. We want to wait for our setups, and we want to be disciplined. And I'll talk a little bit about what happens when you're not disciplined. And then lastly, I just believe that if you dedicate at least an hour to, looking at charts, trying to familiarize yourself with them, because again, starting off as a beginner, or even, a few months in or whatever, it takes, you got to continually sharpen the muscle. Okay. So it's not something that, you're going to get right away. Okay. But as I always say, we can all do hard things. So just keep that in the back of your mind, but it definitely is going to come by way of studying. So definitely got to make sure that you lock in. I would, make checking the group app something that you do every morning when you get up. Every morning I go and look at charts between 5:30 and 6 a.m. So really, really, really important for all these things to make you a successful trader. All right, so now we'll talk about really briefly how to place a trade in TD Ameritrade. Okay. We'll start here, and then we'll kind of go to the why we take trades. Kevin, you want to take this part away?
All right. How to place a trade in TD Ameritrade. Okay. The first things we want to do, let me,
Yeah, share your screen.
yeah, I'm trying to get out of this full screen mode. All right.
Wouldn't it be nice?
All right, here we go. So now the first things we want to do is get familiar with the platform, TD Ameritrade, okay? Because this is where we're going to be taking all of our
I don't think
trades.
you're hearing.
Oh, hold on. Hold on 1 second.
Oh my God.
There we go. All right. All right. So the first thing we want to do is get familiar with the platform, simply because this is where we're going to be taking all of our trades. As you guys join the group, I do have some videos where I actually walk through all of these steps in terms of how to do it from your cell phone and your tablet as well. All right, because most of you guys have jobs and won't be, stationary at a computer or a desktop all day long. All right, so it's pretty much almost similar to what I'm about to go through now. Okay, on the desktop. All right, but you can also do it from your tablet and from your phone as well. All right, so the first thing you'll do is when you sign in, this is a paper money account, but the first thing you'll do when you sign in, it'll look something like this. All right, and then it'll have your positions and all these different things on here. Okay, one of the things that we want to make sure we do is we want to come to trade. Okay, we want to come to trade, and then this is going to bring up all of your options and all of your things in terms of your symbols and the different stocks that you're trying to trade. Okay, now the first thing you want to do is to come up here and you want to type in whatever stock, if it's Apple, whatever stock you want to type in. Okay, for smaller accounts, and what we're starting off with for those who are new to the group is QQQ and SPY stocks. Okay, all right, this QQQ and SPY stocks are the two that will actually be trading, simply because they move, they have a lot of volatility, they move pretty fast, all right, and the contracts don't cost a lot to get into. So you can start with a smaller account size and still make some good money trading these two stocks. And they also work pretty similar to each other. So if SPY is making a move, QQQ is most likely making the same move, okay? All right, so when we get in here to take a trade, your screen will look something like this. Then you'll select option chain, okay? All right, and typically we trade same day contracts, okay? Once you select option chain, you'll have a drop down of all of the different expiration dates, okay? We typically trade same day expiration dates. These are gonna be the cheaper contracts to buy. The longer the expiration, the further out the expiration date, all right? The further out the expiration date, then once it'll be, give me 1 second. Gotcha. All right, so the longer out, the further out the dates, all right, the more money they'll cost, because the more chance or opportunity you have for the market to go in your direction. So they're going to charge you a little bit more for these particular contracts that are further out. So again, starting off, you want to, do the same day contracts. And when you pull it up, it'll look something like this. Okay, it'll look something like this in terms of how getting into the trade. Now, I'm going to go through each one of these columns here pretty briefly, but very thoroughly. All right, so the volume, this first column that you see is the volume. It basically shows how many people are technically trading at whatever strike price. The strike price is in the middle. All right, the volume tells you how many people are actually trading at this price. One of the things about trading is when you enter a trade, you want to make sure people got in before you, and you want to make sure people are getting in after you. So this volume is a very good indicator that this particular strike price is a very good entry point. All right, open interest, which means that the number of contracts that are actually open for this particular strike price. All right, also good information. Okay, the delta, which is something that's very important. All right, when we talk about taking the trades, All right, I'll come back to that in just a second. All right, the probability of being in the money, okay? All right, I'll come back to that also in a second, okay? Now, on the left side of our strike price, okay, all right, is our calls. All right, this is where we take a call when we expect the market to be moving up. All right, the right side of the strike price is the put, and we expect the market to be moving down, okay? All right, so on the right side, this is where we take a put. On the left side, this is where we take calls. We can make money whether the market is moving up or whether it's moving down, okay? All right, now, when we buy a contract to get into a trade, we want to buy the asking price and we want to sell the bid, okay? So when we get in a trade, you always want to get the asking price,
You got a
okay?
question?
I'm
What's
sorry.
the question? Yep.
I'm sorry. Are you on the computer, correct?
Yes.
Okay, my bad.
Yep.
Just want to make sure.
Okay. Yep. I'm on the computer here. All right. So now when we get into these trades, for the sake of these numbers, let me go to tomorrow. Let's see. Yeah, we'll just use tomorrow because today is technically over. So we'll just use tomorrow so I can get some kind of more accurate numbers here. All right. So on the right side is put, left side is call. So now we have what we consider in the money. Okay. So the ones here that are this shaded column, all right, this shaded column down here and the shaded column up here is what we call in the money. Okay. In the money. Okay. All right. You got one in the money. All right. Left side of strike price goes down. Well, the strike price is in the middle. Okay. So the strike price is going to go for some reason it goes down, but as it goes down, it's actually going up. So as you can see, 395, 396, 397, 398.
I think they mean if for the calls, if you're taking a left side of the strike price, those are call options.
Right. Is that what you're asking?
Yeah, I'm not sure what they're explaining.
Yeah, left side of strike price goes down. I'm not sure. All right, but so again, so this is in the money, and the darks, the blacks area is what we call out of the money. Okay, so in the money just means that the market is basically at your current price. All right, at your current price. Now, for smaller accounts, what we encourage is that you take 1 to 2 out of the money. Okay, 1 to 2 out of the money. Okay, all right, 1 to 2 out of the money. Now, the reason for this is you'll get a cheaper contract. So let's just take this, for instance, 401. Let's say we want to take a put at 401. All right, this put is basically this 2.50. And so basically you move the decimal places 2 places to the right. And so technically, if you wanted to take a put in the money at 401, you would be paying $250 per contract. Right? So now, if we were to take 1 to 2 out of the money, okay, all right, you would then be paying $162 for the same contract rather than the $250. All right, now, when we take the contracts that are out of the money, okay, we want to make sure, like I said, I'll come back to this delta. We want to make sure the delta is a 0.30 or higher. All right, and the delta basically determines how fast or how slow you lose money. Okay, the higher the delta, the faster you're going to either gain or lose money based on whether or not the trade is going in your direction. Okay, so the delta, and again, the smaller the delta, all right, the smaller the move. Okay, so while we can take 1 to 2 out of the money, as long as it has a 0.3 delta or higher, you can still make some good money. Okay, so each contract, so for instance, 398, all right, if we were taking a put, will be out of the money. So we could take the same trade and rather paying $250, we could pay $128 for a contract because it has a delta of 0.33 or higher. All right, now, I said I would come back to this, the probability ITM of being in the money. So you have a 39% chance of the market going from 401 down to 398. Because when it's in the money, all right, it's going to be a higher price for you. Okay, and that's how you make your money. Okay, that's how you make your money. All right. Yes, the delta on the put side is always negative. It goes from negative basically 1 up to negative 0.1 up to 1. On the call side, it goes from 0.1 up to 1. All right. All right, so now, once we give you the area of where we want to take this, okay, all right, the market when it's open will be constantly moving. So the prices will be constantly fluctuating. So what you see now at let's say we take this for 162, we want to take a one out of the money, okay? So we want 162, okay, all right? And when we do that, the prices will be fluctuating. Once you click what you want, then this screen pops up, all right? It tells you what you're trying to do. You're trying to buy, okay, December 15th, all right? All right, expiration date of the contract, the number you want to put, and then the amount of that particular put. All right, so again, we're buying. This is the number of contracts. Again, for beginners, I encourage maybe one to 3 contracts, depending on your account. Okay, depending on your account. If you have a $500 account, I would probably recommend 1 to 2. Okay, all right. Yeah, I would recommend 1 to 2. Okay, all right. But again, it's your money. You can do whatever you want, but I would encourage, again, for beginners to take maybe 1 to 2 contracts. So what this means is that I'm going to be paying $162 for 1 contract. All right. And I want to put, all right, at this price, all right, of $399, although the market is currently at 400, I expect the market to come down because I'm taking a put. I'll come over here, I press market order. All right. Market order means it's going to put you right away. Okay. Then I'll select review. Okay, it'll come up and it'll tell me the amount that I'm going to pay, $160 plus a commission fee of 65 cents, all right, which is a total of $160.65. Now, you don't actually pay that amount to buy this contract. You just have to have that in terms of leverage, right? So you have to have at least $160 in your account to be able to buy a contract. That's why we always encourage at least a minimum of about $500 to $5,000 to fund it, so that you can have the buying power to at least buy into 1 to 2 stocks. Okay. Now, once I select send, all right. Now, if this was a live trade, okay, it would put me right in the trade. Obviously, the market is closed. All right. Then when you come here, you'll see your positions here. Okay. You'll see your positions here. All right. And again, the profit or loss for the day and the profit or loss open, these numbers will be moving. If it's green, that means you're in profit. If it's red, that means you're out of profit. All right, so that's how you take a trade. All right, so I'll cancel this. All right. All right, so any questions so far in terms of how to get in a trade and what this area here means? Any questions on this so far? No
Can
questions?
you show how you got in that again? How you first got into it on the computer? I've done it on the phone, but I haven't done it on the computer. That's why I'm asking. Man. Sorry.
Okay. All right. So essentially we get to whatever price we are. All right. So just say this time I'll go over a call. So again, the call is on the left side of the strike price. Okay. And again, all right, we want to buy the ask price. Okay. Not the bid price. We want to buy the asking price. So if it's a call, we're going to be here. If it's a put, we're going to be here. Whatever the number, just say we're at 400. And again, beginners and starting out, we want to take 1 to 2 out of the money, all right? And we want to make sure it has a delta of 0.3 or higher. So we got 3 of these that are out of the money, all right? And it's just based on, all right, what you want to pay, all right? Again, the higher the delta, the faster you're going to gain or lose money, depending on whether or not the trade is going in your direction, okay? All right, so for this purposes, we'll take this one. So once you click the ask price, it'll bring up this menu. All right, again, you'll change your contract. You change your contracts, okay? All right, and then again, you're buying 1 contract. This is the expiration date. This is the price the strike price that you're getting in at, and this is what you're doing, either call or put. All right, you'll come over, you select market, you'll select review. It'll give you the cost of your trade, okay? And again, This is not what you're going to pay. This is just what you have to have in terms of leverage. Okay, so you got to have at least $192 in your account to trade one contract. All right. Again, you hit send and boom. If the market was actually open, this would have immediately put me into the trade. This would have immediately put me into the trade. Okay. All right. All right. Now, once I select that, I close the option chain, and then it'll tell me the positions that I'm in. And again, these numbers will be moving up and down. If it's green, that means you're in profit. If it's red, you're out of profit. All right. And if I was in this trade, okay, I would select this is where it says edit selected. It will say close selected. And it will bring up the same menu for close selected as this. It'll bring up this same type of menu. And then again, you'll put market, and then you'll put review, and then you'll put send, and then it'll close and take you out of that trade. All right.
Okay.
Appreciate it.
Yeah.
All right, before we move on, any other questions about this area here?
Yeah, Kevin, can you go over that once you got that price, right? Our strike price where we want to go in for the ask.
Mm-hmm.
What was that? Where you changed it to limit? How did you do that?
Oh, well, I changed it from a limit to
From
market
limit
order.
to market. Yeah.
Yeah, just right over here on the side. And on a cell phone, it'll be or a tablet, it'll be a arrow that you just select to change it to market. But you'll come over here, change it to market, and then it'll be a market order. And then you'll select review. It'll go through that process again, and then you'll hit send.
Okay.
Yeah.
I think somebody asking.
You know, call and a put. We're going to cover that in just a bit, Michael. But essentially, a call is we expect the market to go up. All right, so we're looking to buy the option because, again, we want the market to move up in our favor. The more it moves up, the more money that we make. And a put is the opposite. We're selling the market. We're selling the stock option, expecting the market to go down.
Yeah.
All right.
Call means up, put means down. And again, you want to, when we take calls, obviously we want to select the lowest possible strike price, expecting the market to go up. And, you know, vice versa for the put. We want the highest strike price because we expect the market to go down.
Okay. All right. So back to this. So your main ground rules, right? Your takeaway here, again, as a beginner, if this looks super confusing, don't worry about it. You're going to see more of it. There will be more help on it. But here are the ground rules. Okay. So for smaller accounts, you always trade 1 to 2 out of the money. Okay. Not 3, not 4, not 5. Trust me, you don't want to do this. 1 to 2 out of the money. Okay. Second point, I definitely suggest you write this down. I'll stay on this slide a little bit longer. Or if you want to take a screenshot, whatever, do what you need to do. Definitely recommend that you write it though over screenshotting because you retain it better. But number 2, you want to buy the ask and sell the put, or excuse me, sell the bid. Buy the ask, sell the bid. So when we're looking to get into a contract, whether it is a call or a put, we are going to buy the asking price. Okay. That when he was showing the option chain, there was a section for ask and there was a section for bid. Anytime we are getting into a trade, if we are entering a trade, we are buying the asking price. All right. This is very, very, very important. Okay. When we're looking to exit a trade and close our positions, we are selling the bid. Okay. Very important that you do not get this backwards, because if you buy the bid, you're going to make money as the market goes the opposite way that we're expecting it to go. So if you get in for a call and you buy the bid, as the market goes down, you're going to be gaining money. All right. But again, if we're telling you that our analysis, it looks like the market is going to be up or going up, you're going to be 9 times or, 9 times out of 10, you're going to be in a losing trade. All right. So that's very, very, very important. Write that down as many times as you need to. Buy the ask, sell the bid. All right, delta needs to be at 0.3 or higher for calls and negative 0.3 or higher for puts. All right, number 4, we want our contracts to be liquid. All right, that's the high volume and the open interest. Making sure that those numbers are not super small is going to be key, because if they're small, that means not a lot of people are trading them and the market is going to move like a snail. And we don't want that unless we're waiting for a bigger move to happen. And then number 5, the premium prices fluctuate. Okay, so when we give you a trade idea, the stock price, or excuse me, the price for the option might be, you know, $53 at the time that we type the idea out. And then the next, as it comes time for you to actually enter the trade, it might have, you know, jumped to like $67. That happens. I'm not sure why. That's definitely on the broker side, but it definitely happens. And again, when you're going into a contract, let's say you are paying $53 for it, right? For one contract. That's the most that you can lose if the trade does not go our way. Okay. So that's what is really cool about options, is that you know, it's very hard to blow your entire account. You got to, you know, work really hard to blow your entire account. So as long as you're disciplined and you understand how to operate the platform, you're going to do just fine. All right. So let me get, I guess, some ones in the chat if I can move on from the screen. I don't know if anyone's trying to write it down. I need 3 ones or more so I can move on. All right, there we go. Cool. All right, so trading 101. Okay, and again, this is for beginners. All right, it's really a scenario in the market between buyers and sellers. All right, sometimes you may hear it referred to as bulls for buyers and then bears for sellers. Okay, when we're buying, when there's a lot of buying happening in the market, prices move up. All right, and when there's a lot of selling in the market, prices move down. So on essentially what we're looking at, what's next here? Okay, so I'm going to go to trading view now. All right. Oh, yikes. I'm going to go to where none of this is showing. All right, so let's just look at this here. Okay, and again, I know it, you know, looks super crazy, but remember, it's just something new. And the more you look at this stuff, the better you will be. All right. So we have a nice little situation here where we see some sideways movement. Okay. And you know it's sideways because there's really no clear direction, right? You have some stuff. Gonna do an ugly drawing here. You have a little bit of down movement and a little bit of up movement, down, up, down, up, down, up, but really it's not really moving anywhere. If we wouldn't want to trade in this kind of condition because it's not really trending, as we call it. But as you can see, you have an area where sellers are the main participants in the market at the time, right? That we know that because the market is clearly moving down here. Does everyone see that? You guys can feel free to come off mute to answer. Like
Yeah, I see that.
make sure everyone understands. Okay, awesome. All right, and then obviously we have a point here where buyers are the main participants, right? The market is moving up, but again, overall, it's sideways movement, as opposed to this candle right here, where we hit a level and the market shot way up, okay? There's a little sideways movement before the market shot down. So this is what I mean here by bulls and bears. You have moments in the market where both buyers and sellers are agreeing on price, right? So we call this consolidation. Ooh, can I spell? All right, you have areas where the buyers and sellers are agreeing. You have an area where buyers are in control, all right? So we can call it bull market, okay? Buyers in control, bulls, whatever. Buying, all these keywords here to kind of help you remember what you're seeing when you're looking at blue candles on my chart. Now, however you set up your trading view, that's going to be up to you. I like blue and red colors, so that's what I do. And then you have an area where, okay, we have a bear market. All right. Sellers are in clear control here. Oh, yikes. Oh my God. There's selling. Okay. So at on a basic level here, right, you can see, again, we have sideways movement. Okay, we have bears in control and we have bulls in control. All right, any questions on this so far? Okay, great talk. All right, so I'm going to get rid of this. Take a picture if you need to really quick. Try and move my cursor. All right, erasing in 3, 2, 1. All right. Oh, Lord.
So I want you to define this consolidation, sideways motion.
Okay, define sideways motion, sure. Again, so what I said about liquidity, okay, liquidity is very important. All right, I'm gonna put that up there. Ooh. All right, liquidity is very important. We know that areas are highly liquid, okay, when you have strong movements in one direction, okay? Sideways movement and consolidation is the same thing, yes. You have a strong movement in one direction, okay? So you can see here, like we clearly have, here, let me make this a little bit nicer. Stop being lazy and make it nicer. All right, so we have an area here where we can clearly see the market is moving down. Does everyone see that from where I'm drawing it right here?
Yes.
Okay, perfect. All right, now you have areas where it's not really moving anywhere. All right, I'm just gonna mark it here. All right, so you have the bottom of this range. You can see that it's clearly forming like a little box area right here. Okay, this is consolidation. This is sideways movement. We don't really want to touch trades like this unless we're going in for a quick scalp, because as you can see to the right hand side of here where my mouse is, it's basically ranging in about 2 points here, going up and down, up and down. We want to catch big moves. Okay, again, unless we're going in for scalps, right? That's a little bit the more advanced style of trading. But unless we're going in for scalps, we don't really want to trade this kind of market because nothing is really happening, right? It's going up, which if you caught it here, that's a great 2-point move, but the chances of you catching it at the bottom and at the top are highly unlikely for anyone, even myself, right? And then if you caught it down, I mean, you might have caught 1.5 points here, but it's not really doing anything for the most part, okay? And if you're not trading more than one contract, it's probably not even worth getting in for the risk because, again, this thing can obviously very quickly come back on you depending on where you got into the market. All right, so we see, let me find a better area. Oh God, there's a lot going on down there. All right, we see an area right here where the market is clearly moving up, okay? Draw a little trend line here. The market is clearly moving up in this area. All right, so that's what we kind of consider the difference, okay? You have areas where market is clearly going up, you have areas where the market is clearly going down, and then you have areas where the market is moving sideways and it's pretty choppy and it's not really presenting a good opportunity to get into a trade. Okay, so that's the first part. The second part of understanding your conditions, or I'm sorry, not understanding your conditions, but trading 101, is that we're really looking for what we call support and resistance, okay? And this is a pretty simple concept, if you ask me. And these gap ups, here, let's see if I can find a good area. I'll just use this zone right here. Okay, I'm gonna widen this out, make this nice and big. All right, but we have areas where the market will come, okay? And it'll make what's called support, which basically acts as the floor. All right, I'm gonna make this blue because you typically, when the market is supporting, it's how many times have you ever stepped on the floor and the floor broke on you, right? That's what you want to think of support as. When you walk onto the floor, we have full faith and confidence that we're not going to bust our butt and the floor is just going to fall underneath us. All right. Not to say that doesn't happen in trading. It obviously can. And then you have areas that what is called resistance. Okay. And it's the opposite of, oh my God. It's the opposite of support. This is areas where it's acting as a ceiling and the market is acting, as if it, comes up, hits, gets a little bit out of there, but essentially falls back in, comes back, hits again, falls back down, comes back a little bit near, doesn't quite get there this time, still falls back down, come back, tries to hit it again and falls back down. All right. You have areas where the market is just not breaking below or above a certain area. Now, what's really important to understand about support, sorry, just realized I said resistance or ceiling. Yeah, let's see. What's really important to understand about support and resistance is that just because it's holding for a few times doesn't mean it always will. Okay, and a perfect example of that is you have to remember that support and resistance can be flipped. Okay, so as we see here, this area is acting as resistance. This area is acting as support. It's moving sideways, not really sure what's going on here. But then you have this support line, right, turn into resistance. Okay, and the market plays off of levels like this. And then you have a new support that's formed. Okay, kind of down, about right there. All right, so you have a new level of support that's formed. So the best practice, again, this is, very basic, but the best practice that you can do for these types of things or to kind of get a better grasp on this is to just kind of go through the market and look for areas where it kept touching and it bounced back up. Okay, or it kept touching and it fell back down. Those are good ways to make sure that you understand what support and resistance is. And then you have trend lines, which can also act as support and resistance. My trend lines are always horrible, FYI. But you have areas where it can either go up, come back down, and then bounce off of the trend line and go further up. Okay, same thing here. It kind of played around a little bit. You got a little sideways movement. All right, but it essentially came down to the trend line again, bounced back up, came down to the trend line again, bounced back up until it started to form outside of the trend line. This is typically where you want to be careful, but this is also a horrible trend line. So you can kind of move it down too. I think trend lines are a little arbitrary. As long as you understand the bigger picture though. That's the best part. And then same thing here, they can act on the other side as well. I'll just draw it right there. On these smaller time frames, because the market only moves so much within a day, it's a little tough, but you have an area right here that acts as a resistance, okay? And then same thing here, it came and touched the trend line, act as resistance. So your best practice, again, is to open up a free trading view account and just go through and draw some trend lines, right? Draw areas where you see it acting as a ceiling. It can be a straight line, it can be sideways, but draw areas where you see it acting as a ceiling and draw areas where you see it acting as a floor to help you better understand this concept. All right, because it can be very complex, but this is on a basic level. Any questions about support and resistance so far? I'm gonna delete this.
Hey guys, just really quick, it's very important to understand we want to trade trends. Okay, when we say a trend, if the market is consistently moving up or down, okay, we want to always trade with the trend. All right, you had me until you said they can switch. Yeah, they could. Okay, so think of it like this. Think of it like this. All right, when you're in a office building, so if you've been to work or at an office building,
A great example.
You have the first floor, right? The first floor, there's a bottom and there's a ceiling. But you take the elevator up to the second floor, that ceiling from the first floor now becomes your bottom on the second floor. All right, then you have a ceiling on the second floor. You take the elevator up to the third floor, the ceiling on the second floor now is your support on the third floor. All right, so the elevator example is a good analogy to help you to understand that support and resistance can switch. Good, good, perfect.
Very good analogy. Okay, Kevin, I know a little something. All right. Okay, so any other questions regarding support and resistance? I'm not going to make this full screen because I'm sure we're going to have to open up trading view again. All right, so we talked about ceilings and floors. Okay, and that's really on a basic level. We'll get into what's a little bit more what you want to be looking for when it comes to any kind of trading. But again, this is a very basic level and very, very important to understand. Now, you're going to see something in the stock market, or you'll see it, not something, but you'll definitely see it. Does anyone see these huge gaps in between here?
Yes.
I say, does anyone see, but of course, all of you see, right? You're probably wondering why that is. The stock market is open Monday through Friday from 9:30 until 4 o'clock, okay? But with SPY and this stock, ES, or excuse me, it's a futures, it's not a stock. It's a futures, it's not a stock. Oh my God. Ignore what you see here. But you see how this future here is still moving. The market is technically still open for this. Okay, let me go to where it's actually open. Y'all see how it's still moving? This is what is causing the gaps in SPY. Okay, so this huge gap right here, this area, it's because ES is still moving overnight. All right, so when you're again, this is a little bit more advanced, but it's good for your knowledge to understand the gaps, why they're happening. It's because SPY follows ES. Write this down. I'll put it on here as well. SPY follows ES. QQQ. Those are the only two stocks that we trade right now. Follows, what is it? NQ? NQ.
Yeah, NQ.
Okay, I just learned that, by the way. But yeah. So these two follow these futures, and SPY and QQQ follow each other for the most part. All right. They make the same moves just about. All right. Obviously, the zones are going to be different, but they make the same moves. So these are what the gaps are, why the gaps appear in the market. And typically we know that gaps, excuse me, the market will eventually close the gaps. All right. Perfect example here. What date was this? I can't see. Hold on.
Oh, this was yesterday. We remember this day.
No, this was Monday. So down here where my cursor is, right here, Monday, this is where the market ended. All right, we had a nice little stinking bull rally. But this is where the market closed here, right? The very next day on Tuesday, market opens all the way up here. Okay, huge gap. But as you can see, market moved down and this gap was closed. Okay. And then same thing for, what am I thinking of? The day before, but I won't get into that. All right, but just know that gaps occur in the market because of the stocks that each follow. Did everyone get that? Were you able to write that down? Okay, probably so. Put in the chat if not, and then I'll type it in the chat. But SPY follows ES and QQQ follows NQ, and that's why the gaps appear. And always just remember in the back of your mind, write this down, the market typically closes gaps by either coming up or down to fill them. All right, that's the main takeaway for now for that. Okay, what's next? All right, any questions so far?
How do you get to the ES and the NQ?
So if you go into the symbol search, that's up here in the top right hand, or excuse me, left-hand corner for our beginners, click on it and you do /ES. They have a million here. I always pick the first one, and so far it hasn't steered me wrong. So pick that one, ES1. And you can also save it to your watch list. I have a lot going on in my watch list that I need to get rid of. But for the most part, I only pay attention to these top 4 here: ES, SPY, NQ, and QQQ. Okay, and then same thing for NQ/NQ, and that brings it up. You can also, I think you might just be able to search NQ under the futures, but I think it was like coming up weird one time when I was looking for it. So I just always do / and then either ES or NQ. Oh, thanks, Kevin. Okay, any other questions regarding gaps, support, resistance, all that good stuff? What's next? Okay, very, very important. All right, this question is going to come up a lot. Okay, it's a great question. It's the $1 million question: when to get in and when to get out. But what you need to remember is that before you put a trade on, you need to have a plan on how you're going to either, manage the trade, whether it goes our way. I mean, we probably have, I'm going to say, a good 85 to 90% win rate when it comes to trading. No one is obviously a mind reader. All the trades will not go our way. It's unrealistic to expect every single trade to be a winning trade. You just definitely want your green days to obviously outweigh your bad days. That means that you are making money and you're seeing progress. All right. But before you even put on a trade, you need to have a trading plan. Okay. And I think this is really great. Now, we said a good amount. It's decent to start off with is $500. Now, what you need to remember that there are some days where the brokers might have insane premium prices, like today. I think, what was it, Kevin? Like one in the money was
$350 when typically it's about $130.
Right. So
one contract was $350 to get into the trade, where it's typically like probably $140 to get into that trade.
Yes. So when you see premium prices, when they're sky high and you don't have that much in your account, maybe you don't trade that day. Maybe you just get in a demo. All right. It doesn't have, this is the first time that I've ever seen the premium prices that high. And I think it has something to do with the Fed news. Interest rates are going to go up again. Surprise, surprise. But yeah, maybe you don't trade that day. So I think that this is a very good basis to go off of, right? So if you're starting with a smaller account, maybe you need to make $50 every day for the next 2 months, and then you need to get out, regardless of where we're saying the take profit level is, regardless of where we're saying, the area is. Like, you need to decide already in your head before you get in, all I need to make is X amount of dollars, and I'm going to get out, and I'm not going to trade anymore for the day. All right. Quickest way to give your profit away is to overtrade. All right. There was a saying, or an acronym that they came up with in one of our other trading groups that we were in back when we traded binary options, called Go Ghost. All right. And that means get out, stop trading, but they spelled ghost without an H. So I always thought it was a little silly, but don't overtrade. Take what you can get, obviously, and go about your business. Enjoy the rest of your day. You will grow your account if you're disciplined. You're probably going to grow it faster than
That's
a lot of people.
Yeah, and one of the things that you pointed out on that very first slide, and what you just mentioned, was discipline. All right, you could learn how to mark up the charts. You could learn all of the patterns. You can learn everything, but if you're not disciplined as a trader, you will always lose. Okay, you will always lose. If you're not disciplined, you will always lose. Okay, and again, you don't want to trade. You don't want to be an emotional trader. All right, which means that if I lose $10, oh my God, if I win, you don't want to trade emotionally. You want to have a plan, stick to that plan, and you'll make money, okay? Because if I make $300 in one day, but lose $500 over the course of the next 5 days, I haven't done anything, right? Mm-hmm. As opposed to if I just win $50 for 5 days, right? That's the equivalent to winning more than I lose, right? Trading is about discipline and consistency. right? Even if I make $10 for the next 30 days, that's more consistent than winning $100 one day and then losing for the rest, the other 29 days. Trading is about discipline, patience, and consistency, right? Start with winning $10 a day, and if you can get consistent with that, then go to $50, then go to, and with the way the market moves, $50 a day is very simple to achieve, but not easy, okay? Because when the market moves, especially if you get a good entry, you're gonna make $50 really quickly.
Right. And I know we said always trade 1 to 2 out of the money, but if contract prices, if the premiums for one in the money are cheap and you want to go for it, go for it. But question you need to ask yourself is, are you risking more than 20% of your account? All right, again, that those premium prices tell you the max amount that you can lose for that trade. Okay, again, it's very hard to blow your entire account. You got to be really talented to do that. All right, if you're disciplined and you're patient, you're not going to blow your account. And if you learn how to operate the platform and understand what we're telling you when it comes to the analysis, right? And obviously, there'll be tons and tons of trainings on them, probably weekly trainings or at least bi-weekly trainings. Yeah, we can. I lost my train of thought. Yeah, you'll start to understand what it is that we're saying when we cover the analysis things. I think I probably posted 50 messages today in our group alone, just kind of showing them what I saw, and still end up missing the trade myself. But I'm gonna wake up tomorrow and I'm gonna be over it, so no worries. But these things are really, really important. And if the trade goes the wrong way, when are you gonna get out? Right? Very bad practice to, kind of see the trade as going the wrong way and like, oh, well, it's going to come back. Again, we're going to teach you, okay, when it's time to get out of the trade, and hey, that one didn't go our way, we'll get them again tomorrow. But don't let a trade just keep going the wrong way, and you're kind of praying and hoping and wishing that it's not, or that it's going to come back your way. That never works out. So don't do it, because it's not going to be good. For whoever's on the iPad, do we need to bring up the option chain again for in the money and out of the money, or are you just saying like verbally?
I think it's better to just bring it up and show them.
Okay.
I got it here.
Close. Okay, go ahead. Kick me off.
All right. So, for in the money and out of the money. Okay. When we say in the money, that means the price is currently, the market is currently at the price that you're trying to get in at. Typically, if it's in the money, again, this gray shaded area, if it's a call, it's here. Because again, if I'm expecting the market to go up, okay, then at 394, because I want to get the market at the lowest price if I expect this to go up. So it's $800 to get in at this strike price, because the probability of the market hitting here, going way up is 71%. So in the money is going to cost you more, all right, per contract, because the probability of the market moving in your direction is very high, right? That's why we say typically we want to take one in the money, or at least 1 to 2 out of the money with a 0.3 delta or higher. If it's in the money, okay, as you can see, one in the money for a call is $300, right? We could take the same call for $193. So again, if it's a situation where the market is moving, it's making its move, we know, we've made our analysis, we know that it's going to go up, then we could take one in the money, right? It may cost a little bit more, all right? But because the delta is higher, the probability of us being, the market hitting our price is high, right? That means the market goes in that direction, will make the money faster, all right? All right, as we take the out of the money trades, okay, just simply means the market has not gotten to our price yet. All right, market has not gotten to our price yet, okay? That's all in the money and out of the money means. In the money, the market is already at your price. There's a high probability that it's going to go your direction. So those contracts cost a little bit more. When it's out of the money, all right, the probability of the market going your direction may be a little bit lower, all right, and the market has not actually hit your number yet. All right, that's in the money and out of the money. Does that make sense? All right, hopefully that makes sense. Okay. Okay, good.
Kevin,
Yeah, go ahead.
while you got that up, can you explain, like, let's say you at work or you in the store and you guys made your analysis and you said the account gonna meet this particular strike price, and then what your analysis say when you should get out of it, how you set limits up for that if you in a job and you can't
Right.
close
Okay.
it,
So,
you know.
okay. So limit orders. Okay. We'll go over limit orders really quick here. All right. So now a limit order. All right. Typically, which means that I want to tell the market that I want to get in at a certain price point or a certain strike point. Okay. So for instance, if I take this, let's say the market is at 400 right now. Okay. So let's say that I think the market is going to go up, but I want it to pull back to my number first, and then I want to get into the trade. So let's just say the market is at 400, all right? And I want the market to come to 398 before I actually get in. So what I'll do is I'll click 398. I'm not going to worry about in the money and out of the money right now for this particular example, all right? But because we definitely don't want to ever take something that's 3 in the money, but we're not going to worry about that right now. I just want to go over this example. So I'll hit, 397, okay? And then I'll set pick my number of contracts. Then I'll set a limit order. Right now, for a strike price of 397, it's going to cost me $456. Now, I can set a limit order. Say I don't want to pay $456. I just want to pay $400. All right? Now, the thing you have to be careful of a limit order, especially if you're doing it by price, this is the asking price, right? Which means that you're going to have to get into the trade or to get your order filled so that you can be in the trade. Somebody's going to have to buy or sell you a contract for basically $56 less than the asking price. So this is a contract that may not get filled. So I would not encourage to do a limit order based on price. Okay.
Contract prices.
Contract prices, right? I would do a limit order based on number, strike price. Okay. So again, if I want to wait, because the market is right now at 399.97. I think the market is going to go up based on my analysis, but I want it to get to 397 first before I get in. So you could tell the market to now put you in for a limit. So that means until the market hits 397, you will not be in a trade. So if you're at work and we call out the numbers in the group, which we do every day, all right, then you can set a limit order. And then once it gets to that price, it'll automatically put you in the trade. A market order puts you in right away. A limit order puts you in based on the limit that you set.
Okay, that makes sense.
Yeah, yeah. Now, any questions? Everybody clear in terms of that?
All good.
All right, good.
You don't have to do an order rule. That's obsolete.
Yeah, well, I'll go over that. I was kind of, because there's some people.
We want to
there's
say
some
that
people-
to the end.
Yeah, there's some people on this call that have never traded at all.
Oh, okay.
So we don't. Yeah, we try not to give them too much. But yeah, for those individuals that have been trading, I guess I can go over it real briefly. No, okay, well, go ahead. I think we're done here then.
Let's do that. We'll do that at the end.
Matter of fact, Kevin. Matter of fact, before you go to that next one,
Right, yeah, Leanne. We know that it's quite a few beginners on the call. So we don't want to do an information overload. All right, we'll do
Okay,
some advanced
what,
stuff at the end.
what were you about to say, Terrence?
I was gonna ask you, when you, that subject you just talked about, when they hitting that 397 on that limit order,
Uh-huh.
does it, if it hit anywhere in the 397, or it got to be 397.00?
Anywhere in the 397. And
Okay.
for that particular asking price, it's going to fill your order.
Okay.
Yeah.
Thank
you. Yeah, no problem.
All right. Oh, let me turn screen share back on. Okay, so again, you know, if the trade's going the wrong way, when you get out, we're going to go over when to kind of know when to get out, or when a trade is still valid or invalid. All right. Are you risking more than 20% of your account? They say 20% is what you shouldn't risk any more than that. I think 20% is a little high, but that's probably because I came off of binary, where it's very easy to, you know, risk 20% depending on how much you're trading. But for, I think stocks, I think that's a fair number, right, Kevin?
Yeah, yeah.
Okay. And then are you trading off technicals or emotion? So Kevin mentioned when you get into a trade, right? You're going to see your profit and loss going green, going red. Obviously, we want to see it keep being green, but we have to trust the technical analysis. All right. And that's the marking up the charts, kind of explaining why we're looking at a certain area, why we're calling a call versus a put, or vice versa. Emotions is seeing, oh my God, it was at $100, but now it's at $50. Like, I need to get out right now. Right now, again, if that's your trading plan and you're good with your $50, take it. But if you have a trading plan where you might need to make $150, and we're giving you our analysis, and we give pretty detailed reasons as to why we're thinking the way we're thinking with a certain trade setup, do not look at your profit and loss. It's the best practice for that. And I'm really talking to myself when I say this, is looking at trading view, right? Obviously managing or making sure that whatever number that we're telling you, you know, in regards to zones, price, whatever, making sure that that lines up, right? Don't look at your profit and loss, because you're going to see it, and you might either sell too fast, and that doesn't, you know, go along with your trading plan, or you might get out, you know, thinking that the trade is going the wrong way, when really it's just experiencing what is called a pullback. All right, so very, very, very important. Trade off technicals. We're not trading off emotion. That's a disastrous recipe for trading. And yeah, we just want to make sure we're not looking at profit and loss as the market is moving up and down. Let the trade form, let it do what it does. And you know, again, everything's not going to go the right way, but most of it will. And that's what's more important. We want to have more green days than red days. All right. Advanced concepts. I'm going to briefly touch over this. However, there will be a trade recap from the trade that we called today, this afternoon, where I'll kind of go a little more in depth. All right. But the world basically goes off of supply and demand. Okay. As the demand for something grows, the price typically gets higher. All right. And as the product grows, but not enough people are buying, then, you know, that's typically where you see people start to discount prices. So if we go, and I'm just going to use these examples here because they're right here. All right. But supply and demand. And again, I'm just going to talk on a very basic level here. I'm not going to go in depth. If you want to stay on the call afterwards and listen to the trade recap, you're more than welcome. That's where I will go in depth on it. But it's just zones in the market where, you know, orders are probably sitting there. Sell orders or buy orders are sitting there. And this is how the banks trade. Okay. So you have areas where the banks have these huge orders that are sitting there waiting, right? The market probably moved too fast when it was up the last time. Let me see if I can find this really quick. I think it's higher though. This was an area that got flipped. But as you can see here, the market kind of moved pretty quickly here. This looks like this is a whole day. Okay, it's 2 days right here, right? And price kind of gapped down and hasn't been back until a few days ago. Okay, so grand scheme of things, you have the banks trade, okay, and the banks really are what move the market. People like me and you, we don't move the market. Our orders to sell a contract or buy a contract option at a certain price does not move the market. The banks does, okay, and they create these zones where, again, they have these huge orders sitting, and the market might move too fast right off of an order at the bottom and take off, okay? But what you essentially are looking for is a pullback, okay? You're looking for selling to happen and come back into that zone, and the probability of more orders from the banks that are sitting there are going to get picked up and shoot the market either higher or lower, depending on if we're looking at a supply zone, which is at the top, typically red, but I said flipped into supply here because it's a turncoat zone. So it was demand at one point and it got flipped into supply. Or if it's a demand zone right here, I got a little small blue 1 hour demand zone here. Okay, again, I'm not going to get into, this is just understanding, it's kind of support and resistance on crack. Much better way to trade and understand how the banks move. The banks are not moving off support and resistance. They're moving off supply and demand. But again, I don't want to overwhelm anyone on the call. So we're going to do a more thorough explanation of that toward the end. You're more than welcome to stay on to listen to it. But that's all I'll say for it right now. Just know that that is an advanced way to trade and find zones and really find your high probability setups. This is your bread and butter. So I definitely suggest that you commit as much time as possible to understanding the basic concept of supply and demand, because I think we have a very easy way for you to be able to identify these zones once you know what you're looking for. All right, any questions on that so far from a basic level? I know it's pretty touch and go of what I just said, but any questions so far on that? Okay. All hearts and minds seem to be clear. All right, you have something what's called confluence. Okay, this is another advanced kind of topic, if you will, that I'm going to go more into detail. But really, it just means if more than one factor line up, then that means that the trade is a higher probability setup. Okay, the factors can be, you know, the 1 hour chart and the 2 hour chart both show an M pattern, for example. And I'm going to explain this again later in a few more slides here, but maybe it shows an M pattern, or two charts show a bear flag forming. You got a supply zone plus an M pattern coming into. Right, that's a higher probability that trade is probably going to go your way. So when what I'm really trying to point out here is when we say when we use this term confluence, we're really just saying more than one thing lines up that makes this trade not only valid but a higher probability. And the more factors you can get to line up for a trade, the higher probability it'll be, the more you know, expected success for it to go your way versus the other way. So you obviously want to have a reason to enter the trade, but if you have, you know, two or more, you know, butter, you got to take those all the time. Okay, is this idea still valid? Now, sometimes we'll have trade ideas that we put into the chat, you know, based off of analysis. And here, I'll show one really briefly. Okay, we're going to take this supply zone here, for example. Okay, that has this crazy mark in here. I'm going to get rid of that. All right. A good reason or a good way to know if it's still valid. Let's say that we're telling you we want to get in at 405 or better. Okay. For lack, I don't want to confuse anyone, but let's say we want to get in at 405 or better. Okay, or higher, because we expect it to come into this zone, hit somewhere in here and fall, which it did here. All right. If the market, let's say we don't see any of this, right, and it only came to 404, the 404 area, right? Would you still have, would this still have been a winning trade if you got in? Absolutely, but it's not good practice. So if the market had come here at this level, right, it didn't quite get here. Oh, that was a horrible circle. Oh, that was even worse. Hold on. Oh my God. There we go. If the market came here instead of where my circle is and fell down, the trade idea is no longer valid, right? Because it didn't come in now. That's not to say that it may not come in this zone again at a later time, but we're only looking at these things from day to day while also understand what's happening at a bigger picture. So you can immediately assume that a trade idea is going to be scrapped if it did not hit our number or better. Does that make sense to everyone?
And really quickly, also, this is also, we could talk about a limit and market order as well. So just as she said, if we told you to set your limits to 405.16 or above, if the market never gets there, it'll never fill your order, okay? So again, just based on what she just said, I wanted to point out the limit and the market order. So if we select the market order right here, where she drew this little sideways line right there, it would put us in the trade right there. And we would have caught this move down, as opposed to if we had a limit trade that was higher, it would not have filled that order.
Okay. All right, now on the same token, does that make sense to everyone just from a basic standpoint? Again, you're going to be scratching your head
Yes.
in a minute. Okay, perfect.
Yes, that, yeah, if I would have had my limit order, I wouldn't have missed that trade today. You're right.
Yeah. Now, I don't really like, okay, this is for, your education only. Don't do what I do if you're not comfortable with it. But I really don't like limit orders. I like to basically just kind of be watching and, ready to go in at market and get out at market. I typically don't really touch limit orders. Not to say they aren't good, though. Definitely a great way to stay disciplined. As you're, starting your trading journey or, continuing on it and kind of growing in it. Definitely a great way to be disciplined. Now, on the same token, okay, there's when to get out of a trade, but it's also when to let a losing trade go. Now, as you can see, this zone here is clearly defined. All right, at the top of this zone is here at 405.84. I'm going to make that red. All right, and the bottom of the zone is here. I'm going to make that white just for distinction. Going to get rid of this really quickly. So we got 404.44 for the bottom of the zone, 405.84 for the top of the zone. Okay. If the market would have come out of the zone and not just wick, we didn't cover that. We'll cover the candlesticks in a second. That's my bad. I completely forgot about that. But if the market had come out of this zone, okay, and formed a candle, gonna try and draw one here. Oh no. All right, that's one. That's already kind of like, this is getting scary, right? But if it continues up, immediately once it comes and breaks the zone, I'm probably gonna get out of the trade. Now, that's not to say that it can probably just kind of, play a little bit out here before coming out, because that definitely happens sometimes. Everything, nothing is 100% in trading, but to obviously mitigate my risk and manage my trade, I'm not going to stay in a trade if I'm expecting to get in about 405 area and it comes and forms a candle outside of my zone when I'm expecting it to come in my zone and sell off. Okay, does everyone understand that? I know this is kind of confusing, so throw some ones in the chat if that makes sense. Mainly for my beginners. I know that the rest of you pretty much understand this. I'm really sorry, all of our beginners. I'm going to explain the candlesticks really quick. Shame on Kevin, he didn't point that out. How dare he? Hold on, let me get rid of the lines. Okay. Do you have that chart with the most bullish, most bearish, or not the chart? It's like a diagram,
Yeah.
or an illustration rather.
Yeah, the patterns.
No, just the chart, the candles. Most bullish, least bullish.
Yeah. I got it here. You want me to share that one?
Pull that up. Yeah. Really quick though, hold on. So as you guys can see, right, we see sticks and we see little lines coming out of them. Okay. This is illustrated. Let me try and find one that's kind of alone. Okay, sorry, I don't want to add too much drawing on here, but I can't get rid of what I got on here. But the top of this candle right here, this big red candle, this is considered the body. And the small little lines, I'm gonna bring this up higher so you guys can see. The small lines here are considered wicks, okay? Now, the body, this is very important. They represent a lot of different things, okay? This is where a candle closes, right? For a red candle, it's opposite on a blue candle. I'll write it out though. This is where a candle closes. And the top of the body is where red candles open, okay? The wicks just mean that price, this is the highest that price came for this specific candle, okay? We'll just say high HOC, which stands for high of candle, all right? All right, and then same thing for down below. This small little wick right here, very small, but this is the low of this candle, okay? This just tells us on a basic standpoint, how low price went in this candle and how high price went in this candle. Does that make sense for everyone? And then same thing here for the blue ones. That's my bad. This should have been one of the first things that I talked about and I completely forgot. All right, so same here. This is the close of the candle. This is where the price actually closed for this blue candle here, this big blue one. Oh, yeah, it's not going to show. And this is where price, I'm just going to put it right underneath. This is where price opened for blue candles. Okay, it's a complete opposite. Then obviously the wicks are the same. All right, so you still got LOC under here. Okay, and you got HOC under there. And that's just showing how high and how low price went for that specific candle. Does that make sense to our beginners here? Throw some ones in the chat if that makes sense. A word. It's not making sense.
Yes, the higher candle, whether it's bullish or bearish, blue or red, like they're not opposite, they don't change how they close.
I couldn't really hear you, Jordan. Did you hear?
No, going in and out.
Yeah. You can hear me better?
Yeah.
Yeah, so you know how like the open and close for the bearish and the bullish candles are opposite, right? The high of candle for each aren't like the opposite, like they stay the same.
Yeah, because the wicks are just the candle can wick in either direction. All right, so you have a high wick. All right, whether it's a red candle or a blue candle, the high of the wick is still going to be the same because it's at the top. The low of the wick is going to be at the bottom of each candle. Right, so the market will close. Okay, now the close of the actual candle body itself is the only thing that's opposite. When it comes to the wick, it's just how far market came down or how far market came up. So the wicks are just high and low. The actual candles themselves have to do it open and close. That makes sense?
Yeah, it does.
Okay.
Okay. For everyone else, is that kind of clear what these candles mean in a nutshell?
Yes.
Okay, awesome. You want to show that that nifty little candle chart here?
This one here?
Yeah.
All right. So when we look at, and again, this is, you can, when you open TradingView, you can make your colors whatever you want, okay? I think it's defaulted to green and red. But again, you'll see blue candles instead of green on a lot of charts, blue and red instead of green and red. But either way, whatever color you want for your bullish candles, okay, this is what they'll look like. When you get a big long candle, okay, it's going to be either most bullish if it's a green one, all right, or most bearish if it's a red one. All right, and again, these are basic candle patterns, okay, which lets you know which way the market is going. So if you see a long wick and a small body, that's going to be, if the wick is below the body, that's going to be a bullish, all right, candle. If the wick is above the body and it's red, it's going to be a bearish candle. If you have, I think what she just showed was a normal bullish and a normal bearish, because you had kind of the same length of the wick on the high or the low. If there's two wicks on both sides and the candle body is real small, it's going to be neutral, which means that we don't typically trade when the candles are like this, because there's no real direction. Okay. All right. Least bullish. Okay. Which means that the candle is basically the opposite of the second most bullish. So again, if we expect the market to be pushing up or in a bullish direction, if the wick is below the bullish body of the candle, that market is going to go up. And obviously, if the wick is above it, all right, then means that it's the least bullish, which means that the market came all the way up here, it got exhausted and came all the way back down and closed down here. That means typically this is going to go in the opposite direction. All right, and it's the same thing down here, all right, for bearish candles. And again, this is just basic pattern structure. All right, it does not always mean that when you get this second most bullish candle that the market won't go the other way. But for the most part, these are pretty consistent. All right.
Any questions on candlesticks? Y'all must be tired on tonight.
Nope.
Okay, perfect. Now we're going to move on to a recap of today's trade, and it's going to get a little bit more technical. So again, you're more than welcome to stay. But any questions regarding all of the basic information covered thus far?
Nope.
No. Any of our new people? Going once.
All good.
Going twice. All right. Okay. So let's talk about the trade from today that broke my heart. Yes, you definitely can ask questions whenever. Let me zoom out just a little bit. Can you guys still see this okay? Price and everything?
Yeah, I can see it.
All right, cool. All right, now today we called out, I'm just gonna copy this circle and bring it over. We called out this area here, all right, for a trade. I think the, I don't know what was the specific range. Let me go see if I can find it in the chat. Okay, at 405.21, I said I really love this 405.21 to 405.84 area for SPY. So let's mark that up, 405.84, which was the top of the range here. So that's why I called that out. And then I'll just move this line up here to 405.21. All right, as you can see, price wicked, all right, wasn't able to close. Thank you. But price wicked all the way up to 405.47. All right, so I'm going to put a line there, put a horizontal one. And let's make it right. All right, this orange line is my trend line here. Again, my trend lines always suck, but today it was great, I guess. So price came here. Now I sent this to you guys as it was forming. I was trying to, we were playing a little guessing game here, but you can clearly see, all right, that the top of the market here came all the way down, all right, and hit here, kind of came back. So I see this bear flag forming. Does everyone kind of see why this is a bear flag? You see this is the stick of the flag, and then this is the actual flag here, this area.
Yeah.
Right. All that area inside, that's the flag. Okay. Also can be considered an ascending wedge and all of that good stuff. But I saw this bear flag forming. Now we know we had news at 2 o'clock, right? So I was definitely wondering, right, how price is going to react after the news. But we have this 45-minute supply zone, okay, and we have the zone because you have a huge bearish candle here, right? Price sold off what, 3 points just about for the close. And then you have this very small basing candle that formed, all right? And then what follows immediately after? A huge drop. Okay, that's what we call a base drop, okay? Otherwise DBD, supply zone. And I put 45 minutes so that you can go back on your charts and see if you see it too. And it also helps me remember where I saw certain zones at, okay? So we had this zone form yesterday at 11:45. Today's Wednesday, right? Yeah. We had this zone form yesterday. Oh my God. At 11:45, okay? So that's one area, all right? Let's mark this down. We got a supply zone as our first area here, okay, or our first reason to kind of be interested in this area. All right, second reason, who can point it out for me? I need either Greg, Terrence, Leonard, somebody can point out to me.
Trend line.
Sophia, who said that?
Trend line.
Okay. Yeah, perfect. All right, we got a trend line. Trend line is also acting as a form of resistance. All right, what else? Why are we interested in this trade here? I already said it, but
The bear flag pattern.
we got a bear flag pattern. All right. We got then also, right, oh wow, Shania, are you serious? What a dork. What did I say? Trend line. Bear flag. What else? What else do we have? It was
Double
from
top?
Tuesday.
Yeah, the double tops, yeah.
All right, right, double top. All right, we saw again, now this double top pattern is all the way up here, right? So why does it matter? It matters a lot because on the day chart, this double top showed up. So that tells me that if it's showing up on a day chart, it's probably gonna eventually get all the way down here to complete the M pattern, all right, in the 391 to 392 area. All right, so we got 4 different reasons why this trade is lining up to be a perfect, not perfect, but a very good high quality setup. All right, would have definitely been perfect had I been able to get in, but so 2 o'clock hits, and I can't see the time over here. Hold on, I gotta move this.
It was exactly at 2. Yeah.
It was exactly at 2. It was so disgusting. But 2 o'clock hits, as you can see, I'm going to go to a 5-minute chart so we can get a better picture of this. 2 o'clock right here, price falls. And I mean, it got rejected as soon as it hit the trend line in this 421 line. So, I mean, that alone was great. But 2 o'clock hits, this thing opens up at 404.79. Wicks up to 404.86, so barely moved and took off. I mean, literally 5 minutes and the market moved, what, 3 points. Huge.
Well, it wicked all the way down there, so even more than that.
Right now, I'm just saying in the first 5 minutes of this candle, took off. Right, and then obviously we know that it wicked all the way down to 396.33. So, I mean, what's that? That's a, oh my God. That's a 9-point move. Oh, my heart is hurting all over again. 9-point move, right? That I think Alex was probably the only person that caught it somewhere up here, and definitely good for him. But the reason why, again, this trade was looking so saucy to me, again, is because we were in a supply zone, okay? And this is the first time that the market came up to touch, well, you know, it kind of played around right here and then came back, but it's the first time that the market had been up here since this zone formed. The zone formed yesterday, somewhere in here between 10:45 and like 11:55. Okay, so the zone formed yesterday. Your supply zones and your demand zones are strongest the very first time market re-enters. Okay, so you have, right, the zone forms. Okay, first time that price re-enters is strongest. All right, and so that was another thing where I'm like, you know, man, this zone just formed yesterday, but it obviously hasn't had a chance to come back in here. And I mean, huge move. So again, those areas confluence, we had, I mean, really 5 things that lined up. Again, you have the supply zone, which is denoted by the red box here, right? We have the bear flag forming, which is denoted by the purple lines that you see. We have the trend line, which is that orange line that's all throughout the market. What else we got? And then we got the double top that we know still needed to form. All right, and then we can even talk about the double top here, which the confluence that we saw here was, again, it was showing on the day chart all the way down to, I think, the 30-minute or the 15-minute chart. That's what, 1, 2, 3, 4, 5, 6, 7, at least 7 charts are showing an M pattern. All right, that's major confluence already, but especially if a pattern is showing up on the day chart, if you see something on the day chart, you got to take those all day, okay? Because that area alone, it's the day chart and 4-hour charts, these higher time frame charts, they're very strong, and the market is going to react to them very much more strongly than it would on the 15-minute, 30-minute, the 45. All right, not only that, but again, we have a zone here, right, that was previously demand at some point. That's why it's blue on my chart. All right, but market comes back. Obviously, market fell below it, probably gap below it, who knows? But it comes back into the zone, and I mean, barely makes it. I think, when did this happen, Kevin? Like at the beginning? This was at market open.
That's when it opened and shot up that high on Monday.
Market open. We typically don't even get in at market open, but I mean, again, we saw it forming, and these are the kind of trades that you literally have to take all day. Now, again, just for clarity, okay, I know I already mentioned it, but had the market come out here and started to play around here, it's probably a nice chance it might have gone higher. So if we were in and it did that, then that's a good area. Once it kind of breaks this 405.84, that's a great time to get out. All right, so everyone, you want to manage your own risk, of course, but I want you to know the best areas in which to know, okay, this trade is probably not going to go my way, or I probably just need a better entry. And you know, that can always be the case. And then what else was I was going to point out down here? As far as getting out, again, we try and call out these zones as best as possible, but your best practice is going to be, if your goal is to make $200 for the day, get your $200 and get out of there. Go about the rest of your day, and you know, take your profits and run. All right. But I do want to point out why, you know, again, those premium prices were stupid crazy today. And I was actually picking Liam up from school when I was trying to watch, you know, the trade to get in, while also, you know, I was typing analysis to you guys, you know, just kind of waiting up until 2 o'clock. And I messed around and got in. I think I got in like 4 out of the money. I don't even know what I was thinking. But my contract price was at like 397. Okay. Now, what is ugly about this is because I got in so far out of the money, as the day started to, or as 4 o'clock started to approach, no matter how far the trade was actually in the money, the delta price had already skewed so much to where, I mean, it was really just, you know, barely wavering in and out of profit, right? So when we say 1 or 2 out of the money, if the contract prices are too high, then just don't get in, or, you know, get in on demo something, or to pay it and, you know, trust that the area, all those areas of confluence are going to go our way. But never, ever, 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 ever do that far out of the money. Again, I was rushing, trying to do too many things at once, and got in there. I don't know what I was thinking, to be honest, but yeah, you never want to do that. Still, the trade was a banger though. If you were able to get in, very jealous, but very happy for you. And yeah, that's really all I wanted to point out for this. I'll still do the usual post all the screenshots and stuff, recapping it. But anytime we see, you know, all these things are lining up for us, I mean, we got to take them. We gotta take them 100%. Any questions so far though? I think Kevin's gonna go over the those. I think Leonard, you had a question about stop loss order, right?
Yeah, when you get out of it.
Yeah.
Yeah. Well, it was when you get out, like let's say you're at work or somewhere and you can't get yourself out of that trade, how you set it up to get out of the trade automatically.
Good question.
So you try a stop limit order.
I guess so, if that's how you call it. Yeah.
Yeah. I don't think it's going to be able to show that to me now, because I'm not going to be able to get in a trade to bring up the menu.
Oh, okay. Okay.
But yeah, when you get in a trade, it'll give you a price. It'll give you a stop limit. It'll say limit, and then you change it to stop limit. All right, and then you could set the price at whatever you want, but make sure it says stop limit. Okay. And then that way, if it gets to a certain price point, it'll automatically take you out of the trade.
Okay. Okay.
Yeah.
Sounds
So
good.
you could set, you could set or you can also set an alert on your phone. You can set an alert on your phone, all right, and then with that alert, all right, it'll let you know, hey, it hit this price. It'll send a notification to your phone.
Question too. You know, when I put a stop limit on that one today, it took a while for that stop limit to be filled. Is that normal?
Yes, because remember, anytime you take a limit, right, you're asking somebody to basically buy your contract, especially if you're getting out. You're asking somebody to buy your contract at a certain price.
Okay.
Which, based on the market where you set the limit, it may not be, I guess, lucrative to purchase it at that particular price point. Okay. So that's why a limit order may not always get filled. When I'm getting out of a trade, I always do market order.
I think that there is a way to set the stop limit, and it should take you out once it hits there.
Yeah, that's what I say it's supposed to, but if he said it didn't do it.
Well, it's probably, Leonard, do you remember how you set it up? Like what you chose?
I can't remember. I'm thinking I put it as a limit because I didn't want to pay that much money. So
yeah, I think so. If you put it at a limit, then that's probably why you have to choose stop limit.
Yeah. So when I sold it, I think it was still on the limit. Right. I was thinking I was getting a market to get completely out of it, but I guess you can't change it. If you got a limit going in, you can't. Can you change to a market going out?
No, you could. Once you set the limit order, you can cancel it. You can always cancel it if it's not filled yet, and select market.
Okay. All right.
Yeah. So, what was the potential to be made off today's trade, if possible to say? Yeah, the potential. I made 2,200.
I'm gonna say
I made 2,200 off today's trade. But the potential. I mean, I jumped in kind of early, but if you had caught it at the top with 1 to 2 contracts and got out at the very bottom, it would have been at least, especially with the price of the premiums being so high, it would have been at least probably the $800 to $1,200 move at least.
Agree. That's why I'm so sad.
Because what I did was when I saw those things coming, and don't take after my trading, because I don't always follow all the rules of what we just discussed. Because sometimes, especially when I see a lot of the areas, I go off of a lot of what I feel. All right. And so I jumped in early. And I
Y'all
was
just stop
actually
listening
down.
right now. Just
I
stop.
was actually down like $400, but I knew it was going to go down because I trusted all the areas.
$1,200 later.
Yeah, right. And it went back down. So
Sophia said never. I know that's right. Someone asked, I'm just going to repeat it because we are recording this, and I know some people are going to be watching the replay. Michael said, so you only buy a trade when you're in the support and the resistance. Support and resistance is really, 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 really important, but we care more about supply and demand. Okay. And now, what they say you should do is, here, I'm going to explain it with where this market came in. Right here. So you see how the market first came into here in this area right here, but then it leaves out. Okay. We can kind of consider this to be, I'm going to put a little line here. I'll make this white. We're not really looking at a break of structure here. Okay. And the reason why we're not looking at a break of structure is because this is basically a supporting area. And all I'm really trying to point out here is that this low is the same level as this low. Okay. Now, if this low, if this low had come lower and then bounced, we have what is called a break of structure. Okay. So that's starting to let us know that the lows are getting lower if it was here. Okay, so we have a break of structure. So when it comes back in, that's another confirmation that, you know what, this might probably go back down again. Okay, this is just maybe if we take out everything else that obviously lined up for us for this trade, and you're just looking at the structure, when it comes back in, so technically Kevin getting in here, or even I think what did you get in, like 400 something, 404 something?
yeah, I got in at like 403.
Okay, cool. So let's just say for, Kevin got in here, right? He saw that, so basically it's an equal low here. All right, it's not really showing you any structure, but it comes into the market again, and typically you want to wait for it to leave, break the structure, then enter the trade. Okay, it's always tricky, but the best way that I can kind of describe it is it's kind of a feeling, right? And the more you trade, the more you'll kind of develop it. You kind of just know when you know, and when you don't, you don't. And that's what we're here for, to obviously help for, those who don't, and to obviously make sure that everyone is taking profitable trades. But it coming into this area was one thing. All right, it didn't really have a break of structure. But when it comes back in, okay, and it touches, I mean, you just have so much going on here, right? In addition to this bear flag, that your risk to reward here, if you get in, let's say you got in right at this 401.21, this area right here, okay? If you got in and it came up here, I mean, what, you probably would have lost, how much, Kevin? Like
4 or
$20
5. So you
or
probably,
something?
based on 1 to 2 contracts, you probably would have lost $50 to gain about 800.
Right. So the risk to reward here is awesome. Okay. I'll risk $50 to make $800 all day. And I hope you do too. Right. But typically what I'm really trying to say is you almost want to wait for it to leave the zone. Me though, how I like to do it is I like to get in while it is in the zone. And if enough things are lining up for me, I have good confidence that it's going to come out of this zone in favor of the direction that I want it to go. Does that make a little bit more sense?
It's also forming a double top there too.
Mhm.
What we call an M pattern.
Yep, that's another thing. And I think I pointed it out to you. I don't know if I put it in the chat, but I want to say on the 15-minute time frame here. Here's another reason why I was looking to get in here, Michael. It's on the no, not that. Wait, is that it? Maybe I saw it on the 5-minute. But you look here, you got a not really. Where did I see that at? Oh, right here. Also formed this little small supply zone. Okay. Got a rally base drop here. Not a great one when things happen on the 5-minute chart. I kind of really don't care, to be honest, because I want to see it on higher time frames. But that is another area of confluence. And then what Kevin said, which is also true, you got what's called a double top, where it's pretty much forming this M pattern. Okay. And that's a that's also a bearish structure where you can pretty much expect the market to come down. We took an M pattern, we took the second top of an M pattern yesterday, and we made some ugly money in there too. So I know that's kind of I don't mean for it to be like a roundabout way of explaining it, but that's just kind of the best way that I can do there. And yeah, there is an order block, which is this red zone here, which is huge confirmation. And that's really how the banks are trading. And we don't want to trade like other traders. We want to move with the banks, because the banks are going to be what's really moving the market. And we want to be on the right side of where the banks are going versus being on the opposite side. So I hope that makes sense. This could have gotten a lot of people into thinking that right here, this area down here, hold on. This could have gotten a lot of inexperienced traders thinking that, okay, we hit this area. All right, we're going up. Boom. Let me get in on this pullback here. This red candle. Sorry. This red candle right here. It go up. It came back in. I missed this entry, but let me get in right here. All right, and then boom, I'm gonna ride this thing all the way up. Now, that's not to say that this doesn't work. Okay, it definitely works. You still would have made profit. But you have to understand the conditions in which you're trading. Okay, if you're going to go in for a buy, you need to be aware of any zones that might be at the top that may be a good area for you to get out, or a good area for you to maybe not trade, depending on how far away it is. Right, and the same thing for a sell. If you're going for a sell, you need to be aware of any zones that might be at the bottom. As either a way to take profit. I think we had a zone. It didn't quite get to the zone. I want to say that it probably will tomorrow though, but it didn't quite make it to the zone yet. But depending on, how far away it is, again, the risk to reward was great because we knew that we had a lot of falling to do. But you got to use zones too as a way to either take your profit, or that zone's a little bit too close to where I want to enter, so I'm just not going to get in the trade. I'm just going to, sit back and watch versus trade. So yeah, lots of things, kind of go into play here. But I mean, this trade, it had just so many things lining up to where, I mean, you kind of just got to take it when you see things like this forming. I say I love to see 3 or more, but sometimes even 2. Yesterday we saw 2 things lining up. If you don't count all the extra time frames that the M pattern was forming on. And we took it, and I mean, it was beautiful. It was beautiful. All right. Any questions on that? And then another thing, one last thing I want to point out, the trade from yesterday, that was Tuesday, right? It's been a long day. I feel like don't know what the day is, but the trade from yesterday, if you got in a little early, like a few of us did, then you would have caught, a nice little 409 price. All right. But if you didn't, remember that everything that goes up must come down. Everything that goes down comes up eventually. All right. So this is what we call pullbacks. You can also consider this to be a small little bear flag forming. All right. But when you see pullbacks happening, and if we're telling you, hey, we're looking to take profit, you know, down here at 402, then that lets you know, okay, it looks like it's pulling back into this area. You obviously want to see if anything else lines up. You know, we'll tell you, you know, if it's a good area to get into, but just for your own understanding, you want to see if there's anything else that kind of lines up, and you could have entered here, right? If you missed the first one, I believe someone did enter here yesterday and they were still end up able to make money and, you know, wrote it down to where the rest of us probably took profit. So, you know, you just got to kind of be aware of all these things. Structures pretty much form all throughout the day. You know, they form on a smaller time frame, which I typically don't like to trade unless it's a scalp and you're sizing in pretty nicely to actually make it worth scalping in for a quick move. But yeah, I mean, you're always going to have a lot of things that line up, and you just kind of want to read whatever the market is presenting and make a, you know, good decision off of there, and not just trade because you see, you know, the price rising or the price falling. I know that was a lot. So any questions on that? Or any questions on anything in general? I don't really have too much more to cover. Like I said, I'll do the I'll put the recap in there with all the writing probably in the morning because I'm tired. But yeah, any other questions so far? Or comments in general, anything that needs to be kind of retouched on, even if it, you know, if it's like something for, you know, candles and supply resistance, all those good things. Oh, somebody joined super late. We almost done, girlfriend. I'm gonna review my notes, a lot of good information. Awesome. Yeah, definitely review as much as possible. Make it a point to look at charts pretty much every day and just try and identify the stuff that we talked about on this call. Yes, I can show a few examples of that. Yeah, I meant to say that too. The recording is definitely going to be posted in the group.
That's somebody in our group though.
Yeah, I'm pretty sure that's BK. Is that you, BK?
Oh,
Yes.
Okay. Yeah, that's BK. Yeah, it'll be posted in the group, and then anyone who isn't in the group, just oh, my foot is very asleep right now. Just email me and I'll get you the recording to kind of go back and review the basic stuff.
All right, I'm gonna go ahead and stop the recording now. Or did you want to show the DBD and RBR on the recording?
Might as well. Why not?
Okay.
Okay. Can we be added to the room? All right. I'm gonna go to a later time frame because I don't want to get the stuff on my chart. But here's an example right here. So, okay, you have a drop, not an aggressive drop, but it's bigger than the base. All right, so you got a drop, you got a base, and then you have another drop. All right, so
I'll show the picture as well so that they can kind of see it.
Okay.
As you're drawing it up.
Yeah, sorry. Okay, so for the beginners, Sophia is asking about basically how to identify supply zones, okay, or supply and demand zones. And what you want to do is just kind of remember these, what these things stand for. So you have a drop base drop. Okay, you have a rally base drop. These are when we are looking to sell. Okay, so here, let's just do sell structures, sell zones, and then buy zone. Okay. And this one is just a continuation pattern, right? That means that the market is going one way, it kind of bases out, but it continues to go the same way that it was coming. And then rally base drop is a reversal signal, if you will. All right, I'll find an example of that to show. And then same thing for buy zones, but the opposite, you have a rally-based rally, which is also continuation. It's going one way, trades sideways for a brief time, and then it shoots back the same way that it was going initially. And you have a drop-based rally. This is a reversal. All right. So let's try and put this somewhere at the top there. Hopefully that's okay to read. Okay, so this area right here, this is a drop base drop. Have a good night. Drop base drop structure. All right. And for drop base drops, you want to do the bottom of the body all the way to the top of the wick. Okay. Sometimes, again, nothing in trading is absolute. You see the market came outside of here. All right. So your best practice, if you think you're seeing what you're seeing, wait for it. Go down to a smaller time. Go down to a smaller time frame. All right. Wait for price to come back in. And maybe as you see volume picking up at this level, you can decide, okay, looks like it's going to be valid. I'm going to get in the trade. All right. Even better, that market structure that I was telling you about, we see that this, okay, is all wick, but it's the low. All right. And you also have here, we'll make it simple. You also have the lows of these candles. Okay. Once this low right here was broken, I'm gonna make it blue so you see. It's not a good color. Let's make it yellow. Once that yellow low was broken, hey, go ahead, get in the trade. All right. Again, if you think you see what you see, then get in the trade once the low of that, this big bullish candle was broken, if you think that the market should be coming down. All right. Does that make sense so far for drop base drop? Let me know if I'm explaining too fast. I can go back. Does that make sense? So Sophia, it is a sad day when you are not able to talk on the calls. I don't like it at all. Let's get that fixed. Let's see. I think this is a 1 hour zone over here somewhere that I got drawn down. Okay. Perfect one right here. This is what I consider a drop. Oh Lord. A drop base rally, right? Now, quite a few things going on with this candle. We'll definitely get those graphics posted on the different candlestick structures. But not only is this just because it's a little doji candle, doesn't mean that, just because it's a doji candle doesn't mean that it's not a base, it's acting as a base. So for drop base rally, I'm just going to put it here because I know there's a lot of different acronyms being thrown out, which is a sign of a reversal zone. Reversal meaning, all right, it's clear that it was moving down at this point. It's coming here. Now we can probably start to expect for it to move up. Okay. But this candle here, you can see I have the very top of the body, no matter how small the body is, all the way down to the lower part of the wick for drop base rally. Does everyone see that? And as you can see, there were two opportunities to take this zone. All right. One right here. Again, I told you the first time that it comes in, it's usually the strongest. Okay. Now, because this drop base rally was formed on the hour time frame, it's strong, yeah. But had it formed on like the 4 hour or the day chart, this thing would have been out of there and probably sent straight to heaven. Okay. But as you can see, if you saw this forming, all right, and you let price come back into it, and I'm on hour candles right now. So here, let me scale down to like 15 minutes so you can get a better picture of this. All right. All right, zone forms here at the base and candle. We have our zone clearly drawn out, so we know what we're looking for. Price goes up. I mean, you had two opportunities to take this, I guess. Right? Let's say you missed it though this time when it came in. You had a second time to take it again and you could have taken profit somewhere in here, hopefully. Okay, and that would have been what, about a 4-point move, but let's just say for, you know, reality purposes, you caught a 3-point move. Awesome point. You know, that's a great risk to reward ratio. And we know that, we know that because our entry would have been at 391.96 stop loss. If it comes out of this zone, I always recommend, if you're going to put a stop loss, put it slightly beneath the zone, because the brokers will sometimes go try and do what's called a stop hunt. But you know, you would have been risking less than a point to make 3 points. All right, those are risk to reward ratios you want to take all day. So that's an example of a drop base rally. Let's see if we can find a drop base drop. And then we still got to find a rally base rally and I think that's it. That's all, right? I think I found all the other.
Yeah.
Okay. Let's see, rally base rally. Ooh, look at this. Looky. All right, this is a great example of a rally base rally. You have a huge move up, a small basing candle, and then a more aggressive move up to continue the pattern. All right, we were going one way. Okay, we consolidated for 15 minutes and we continued to shoot right back up. We also closed the wick. All right. So what am I looking for?
I can also show the pictures too, just so they can kind of get a
for sure
clear look at it.
So here's the zone right here. Again, it came out slightly, but what you can always do, oh my God. Oh, okay. What you can always do is if you see the zone forming on a 15-minute time frame, you need to see the structures. Listen to me when I say this. You need to see the structures on a higher time frame, okay? But you need to enter on lower time frames. All right, so I'm typically seeing structures on the 1 hour, 2 hour, 3 hour, 4 hour day chart. I'm probably entering on the 15-minute chart, okay? Because that gives you a better chance of entry. You can see more where the market is going when you scale down for your entry, okay? But you want to see the structure forming, the highest probability setups. You want to see them forming on higher time frames, all right? And so if you came here, right? And let's say, it came out, so you're like, ooh, I'm not touching this out here, right? You can wait for price to get back in here or something. And again, trust your analysis. If you see it happening, as you can see, had you got in, I mean, you would have, this is right 5 minutes before the market closed, you would have made some profit. Now, obviously, that's to say, be careful when you're taking trades close to the market close, because they get worthless as expiration, approaches. Same thing here, right? We see this little small rally candle. Now I see it on the 5-minute chart. Do I like it? And would I probably take it? Probably not, all right? But if you have more confirmation that lines up that this can be, I'm gonna make this blue so I don't confuse anybody. But if you have more, make it light blue. If you have more confirmation other than this 5-minute rally forming, then I mean, take it. Because as you can see, if you would have gotten in, I mean, you could scalp. This is a great way to scalp on the 5-minute chart. If you want to scalp, you can do it on the 5-minute chart. Again, if you want to scalp, do it on the 5-minute chart or a lower time frame. But I mean, if you got in here and let's say you decided you want to get out here, even that was you would have gotten about a point, a little less than a point. And of course, obviously, if you would have continued to hold up into about maybe here, or more realistically, you probably would have held held on to it to about here. That's about a 2-point move. So that's pretty good for a scalp. And if you have the account size to kind of get in and throw a few contracts in there and let it ride, then do that all day. Another drop base rally structure right here. Okay, so you're really just looking for small basing candles. Again, I'm using the 5-minute because you can kind of just see them very clearly here. You don't always want to use them, but they're significant. Same thing right here. You got a drop or excuse me, you got a rally base drop right here. Right. And as you can see, the next time that price came here, it rejected. But again, 5-minute time frames are not that reliable when it comes to these structures. So you want to be very careful. If you're getting in for these moves, they have to be scalps if you're seeing them on smaller time frames. You cannot get in and expect them to for this thing to just keep going your way. All right. Recipe for the disaster. So again, if you see these zones forming on smaller time frames, you need to understand that you are scalping. You're not holding on for 4 and 5 and 6 points. You're looking for scalp moves. Does that make sense? Is that clear for everyone on, just what you're looking for these structures? Okay, I think I covered them all, right? I want to say I identified all 4 that you can have. Kevin, if you want to throw that graphic up there to show them.
Oh, okay.
Ooh. Woo. Awesome, Michael, awesome.
There's a couple of them. Let's see.
Oh, I don't like these.
Huh?
Little hard.
Can you see this?
Yeah, you see it perfectly. No, go back to how it was the first time. Yeah, keep it like that. You see it better that way. But yeah, as you can see here, now, obviously this is scaled down. So you're seeing more of the base, which is, when we say base, we really just mean it's an area of consolidation, okay? So it's a little bit easier to see when you can just see those 3 candles, that 3 candle structure that you're looking for that I pointed out, but these are still very significant, all right? You have your rally, base, rally. Again, you have strong upward movement, consolidation, continued strong upward movement on the right-hand side. And then you have strong downward movement, consolidation, we're going sideways, and then continued strong downward movement. Okay, so these are drop base drops and rally base rallies. And then I think he has one more that shows the
Yeah, let me show this other one.
And again, look what it says, trend continuous base. All right, very, very, very important to realize that drop base drops and rally base rallies, write them down. Drop base drops and rally base rallies are continuation zones. All right, and then trend reversals, you have rally base drop. You have strong upward movement, we get into an area of consolidation, and then we have an aggressive drop. All right, and then it comes back up into the zone. It's a perfect place to take your entry or wait for it to leave the zone and break the low, as you can see it did. Because we're looking here on the second time that it entered in between the lines here. Kevin, can you put your cursor on it so they can see? Go over. Yeah, this one. You can see that this red candle broke the low of the green candle. As soon as it break and hold for about 30 to 40 seconds, get in, jump in, market execution in, write it down to the next zone or area of interest that makes you think I should probably get out of this trade here.
And here's one last one that'll also show it as well. Pretty good one to see.
Oh, nice. Ooh.
All right, so you got your drop here. Base, it's in a demand zone, and then you got your rally up. All right, then it comes up to a supply zone. You got your base, and then it drops down. And it repeats the cycle again over here, hits this demand zone again. Got a drop, base, and then a rally. All right, so this is a good sign here.
Also, can you go to that second time that it goes back? As you can see, that drop into the demand zone again. What happens? Someone come off mute and tell me, what do we see that just happened in the demand zone? I know you got to see it.
It reversed.
Yeah, but what's significant about this small candle here before the reversal?
It's a doji.
Mm-hmm. And
It became a base or something.
yes, now I don't like the candle, like obviously that's a huge wick there. So I'm sure if this example was showing on a higher time frame, you would see more of a solid candle versus this wick here. But you're right, that doji formed in a demand zone. All right, and dojis, when you see the market coming down and you form this very small candle, that's typically another sign of the market getting ready to reverse. So you have two areas of confluence that are working in your favor. You're coming back into this demand zone that just formed, and then you also get a doji that forms in there again. Again, you got to take those all day. Those are money. Right on the money. Any questions on that at all? Are y'all frozen? Oh, you moved. Like you were frozen for a second.
Here's just one just for on our way out. Just different pattern structures.
Oh Lord.
All right, won't show that one long.
I don't know these structures myself because a very handy dandy trading book that I lent out to someone never got back to me. So you gotta sometimes Google, make sure I'm looking at the right stuff. But yeah, we'll post this recording as well as these patterns that we just showed. Stop looking like that, please. As well as these patterns that I'm tired. These patterns that we just showed, so that again, you can start to familiarize yourself with structures, candles, all that stuff. Again, I know it's probably a bunch of gibberish right now to some of you, but you have to remember that it's just new information. And the more and more you expose yourself to that information, the better off you're going to be. And you'll just, things will just eventually start to click for you before you even realize. But repetition is key, and just looking at this stuff multiple times, throughout the week, day, again, an hour of studying, and all that good stuff will keep the 9 to 5 away eventually. So definitely, get your study on. Open up TradingView, get a free account, and just start practicing. Send screenshots of this, to kind of verify if what you're seeing is correct. More than happy to confirm for you between Kevin and myself. So yeah, that's pretty much it, unless anyone has any last questions. Excuse me. No problem, Soph. No problem. Glad it was helpful.
You're welcome. You're welcome, everybody. Nothing else. I'm gonna go ahead and stop the recording.